Welcome to BusinessLine's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to BusinessLine's State of Economy podcast. I'm your host, Haripriya, tech reporter for the publication. In today's episode, we will be discussing the growth prospects of Indian mid-tier IT companies and how they fare in comparison to their larger peers in the industry. To give us more insights on what's happening in the space, I have with me today Sumit Pokharna, Research Analyst and Vice President at Kotak Securities. Thank you so much for joining us today, Sumit.
Thank you for giving me an opportunity to share my ideas out here.
Great, sir. So maybe we can begin with the broader industry overview. We see the growth momentum has slowed down and the boom that we saw earlier has bottomed. Given the macro factors, what is the demand environment like currently, and what are the challenges that companies are facing?
So definitely you have mentioned it correctly. The entire IT sector is facing multiple headwinds out here. It's more to do with global scenario with monetary tightening and geopolitical concerns. Clients are skeptical on investing whether on IT, and they are just looking for projects which are core to their business. So there has been some cut down which has been seen in the digital spending. Weakening of discretionary spending has impacted Indian IT companies a lot. Now, large cap IT companies got major hit because of the size which they are doing, and the clients suddenly stopped spending on discretionary spend, which has impacted meaningfully to those guys. And the same is visible in the quarterly numbers also. And however, things are improving from here, but it will take its own course of time to see the full benefit coming from the recent deal wins. It generally take 2 to 4 quarters to reflect in the revenue. So in the broader context, large cap IT companies, Indian IT companies got impacted because of the global issues. They have the capabilities. They are going to be proved as a winner once again once the macro things improve. So far, mid-cap IT companies are concerned, they are doing phenomenally well as compared to large cap IT companies, mainly because of strong deal wins and faster conversion to revenue. Also, their base was lower as compared to large cap, so the growth was easy for them to be reflected in the numbers. Thankfully, cost management has received escalated focus, driving margin expansion and cushioning earnings against revenue headwinds. So that is quite positive on the broader context of IT services.
Right, a lot of thoughts to unpack this, sir. We'll speak more about that. But some of the companies we talked to are expecting conditions to bottom out by end of Q3. So, what is the visibility that the client base has for the industry as whole? And will the fresh budgets that are set to come in January be less modest, and will that help pick the demand better?
Yeah, so thing is that generally first half is better for IT companies as compared to second half of any financial year because of furlongs in Q3 and other reasons. But if you go and do the analysis of earnings call commentary of US and European BFS firms, which indicates continuing focus on expense management leading to plant headcount reduction. So what I'm trying to say is that there a lot of restructuring is happening in several cases, and they are all focusing on cost cutting. So cost management measures can lead to closer scrutiny on tech budgets, impacting recovery in discretionary spending and consequently growth in calendar year 2024. So this is the other side of the picture, which is I'm talking about companies or the clients or banks which are based in US and Europe. They are talking about little caution on the IT spend. So expect more large, but this also throws a lot of opportunities for large cap Indian IT companies because you get opportunities in cost takeout for Indian IT companies. So TCS, Infosys, HCL Tech, in certain cases, LTI, Mindtree, Emphasis, and Coforge are better positioned to take benefit out of these cost takeout opportunities.
Sir, as you mentioned in the beginning about mid-tier IT companies doing better, could you give us more insights on that? What are the kind of opportunities that they're going for that is helping them thrive better? Uh, why do they not see delay in conversions like the larger peers are seeing?
So as I mentioned, that large peers, the two main reason is that first is their size is very big, and they have shown exponential growth in FY3. So for example, Infosys has grown by 15% in FY23. So the base itself becomes so big. Getting growth on a strong base is difficult, particularly in when the macro headwinds are quite strong. coming to mid-cap IT companies, the base was lower, plus the type of clients they are catering to are different from large enterprises which are based in US and Europe. So the suddenly the discretionary spend took a hit. The clients started cutting down the discretionary spend unexpectedly, as certain projects got postponed, certain projects got stopped there only, and they started focusing on cost measures. So that resulted in a big hit for large cap Indian IT companies. Coming to mid cap IT companies, the outsourcing was coming on, the projects were going on. In the meanwhile, the size of the clients were smaller. They have not got impacted as severely as large enterprise clients got impacted. The benefit of that lower base and other things and faster execution of the deal wins has resulted in better management of their revenue growth and earnings. But uh, given the current valuation, most of the positives, according to us, are priced in the valuations. Going forward, if you look in Q3, we have seen large cap IT companies are focusing on reducing their subcontracting cost. These subcontracting cost was basically revenues for mid cap IT companies. So in a way, it might take 1 or 2 more quarters, but the pain will be reflected in mid cap IT companies where the growth will slow down. In certain mid-cap IT companies, we have seen the pace of growth has gone down. They are growing, but the pace of growth has gone down. And because of two reasons, obviously the base has become stronger for them too. And at the same time, they will also face some macro headwinds in terms of discretionary spend cut and other things. So it will never happen that only large cap will keep seeing the pain, and they are reducing their headcounts, they are reducing their subcontracting cost, and mid cap will guys will not get impacted. So valuations are already rich out there, and uh, as the earnings will take some hit, maybe 1 or 2 quarters from here, then we might see major correction in these mid cap IT companies also.
So, which are the specific vertical or the niches that the mid-tier IT companies are catering to, where the spending is still robust?
I will take both the examples. First is where the pain is visible in mid-cap IT companies. Let's take an example of Happiest Minds. The company has got very high exposure to discretionary spending. It is around 95% of their revenue comes from discretionary spending. As I mentioned, that clients are not focusing on discretionary spending, as a result of which the revenue got impacted and the company has to cut down their revenue growth guidance drastically. So it depends on what type of work you are doing for which client and in which area you're catering to. So weaker vendors in client ecosystems are at a high risk of getting impacted by cost takeouts and continuation of insourcing agendas of select firms. So that will also impact these mid-cap IT companies. So what I'm trying to prove here is that depending on what which segment you are catering to, how much is the legacy business you have, and how much is the digital transformation focus you are keeping. Depending on that, the hit will be reflected. As of now, most of the mid-cap IT companies are focusing on cloud transformation, automation, digital transformation, and that also the clients which they are catering to are smaller in size. So it becomes easier for them to do that, and as compared to large enterprises which have taken a big hit because of the rise in the interest cost, particularly large banks in US. One of the banks which has gone was under deep trouble. So these enterprises were clients of large Indian IT companies. That is why the hit was seen more in the large cap IT companies. But as I mentioned, now Indian IT companies, large cap IT companies, are cutting down on subcontracting work. That means that much work will go lesser to the mid cap IT companies, and the pain will be seen somewhere maybe 1 or 2 quarters down the line from here on.
Right. Are there any outlying specific industries like auto, the spending remains robust, someone like a KPIT is doing well? Are there any more industries like that, specific, which these guys are tapping into?
Yes, so what is happening is that I was talking more from a IT services company. KPIT is more of an IT engineering company. So there the client base is totally different. The type of work which they are doing is different from as compared to IT services company. The good part is that lot of Indian IT companies has also moved to engineering work. That is why the mid cap IT companies got a cushion in terms of demand for those work. Particularly, KPIT has got a higher exposure towards auto sector and the demand for autonomous cars, driverless cars. So that demand remained very robust. As a result, the order flow was very strong and the execution was very fast from their side. So they got benefited out there. But uh, going forward, once this the work will get over, maybe within a 1 year's time, then the more of a maintenance work will come to those guys, because more you can't you have written the codes once, the main structure is ready. Every year you will not get similar type of work, but as soon as those projects are ready, then you will get a maintenance work, which may not be as the deal size may not be as bulky as for the original work is there. So I think KPIT we have to keep it separate because it is a more of a IT engineering company rather than IT service company.
Understood, sir. Sir, you were mentioning about how they might start feeling the pain soon, but we see a lot of them have retained the guidance. But what is this contrast that is going on? Because we see large peers being very modest on the guidance. What is giving the confidence to these companies?
See, what has happened is that the deal pipeline or the deal wins has been very strong for these mid-cap IT companies, and the execution is going on perfectly. So FY24 will be great for those guys, but we might see some pain after that. That's why I'm saying it may be 1 or 2 quarters from here. After that, we will see that growth may taper down for them. Particularly if you look at the numbers for few of the mid-cap IT companies, the growth has already slowed down. Earlier, they were growing at a much faster pace, and the growth is now going down for them. They are growing, but the pace of growth has gone down. So that will get be more skewed or maybe more under more pressure going forward. Spending on governance, risk, and compliance may remain steady or can increase. So depending on which category they are catering to, workload migration to cloud, core modernization, cyber security, automation, and advanced analytics, these programs with clear return on investment will be prioritized by the clients. So if these companies are catering to those segments, then definitely they are going to do well. As I just gave an example of Happiest Minds, they had initially given a guidance of 25%, but because their exposure is too much into digital side or the latest technologies, and where the clients are cutting down spending, so that will get impacted significantly, and the future course may remain further painful for them. But from a little longer perspective, I think the growth opportunities for both large cap and mid cap IT companies is robust.
Got it, sir. These were the questions we had for you today. Thank you so much. This was great understanding from you. Thank you.
Thank you. Thank you.